Good evening. We'll begin with departmental accounts. Before we start with the departmental accounts, when branch account model is followed, when you're having two or more locations of business. Here, when you are having two or more products or services, okay. See, there is no problem in dealing with direct expenses. Sales, opening stock, purchases, closing stock, direct expenses are directly available. You can charge it in trading account, P&L account, no problem. For example, let us assume you are having a departmental store with 4 products like cosmetics, vegetables, or it can be even medicines, things like that you are having. You can identify direct items directly. What are the direct items you can identify? Opening stock, purchases, sales, closing stock, wages you can identify. Other expenses will be common. For example, rent is common, electricity is common, advertisement expenses are common for all the departments. So what to do? We have to allocate or apportion. Same like in costing, you would have learnt in overhead chapter. Same principle we are going to follow. Let us go to the example. You can write in the material itself. How to allocate these indirect expenses? For 4 departments, rent is paid commonly. For 10 departments, rent is paid together. How to apportion? Rent based on what? Area occupied. Rent based on area occupied or floor space occupied. Then square feet or whatever. Rates and taxes also based on what? Area occupied. Then energy expenses means power consumed based on kilowatt capacity. Then what about bad debts, etc.? Based on credit sales. Based on credit sales you can apportion. Then carriage inwards. Carriage inwards, sometimes for carrying all the 4 goods together, we would have paid to a lorry. Clear? We are carrying cosmetics, vegetables, everything in a lorry. We are paying total carriage expenses. Suppose if you are not able to identify separately, then allocate based on what? Purchases. Wages, salary, labor, welfare expenses. Okay, based on what? Number of employees. Then administrative expenses can be based on sales. Sales or turnover. Depreciation on repair of machine will be based on value. Depreciation, repairs and maintenance of machines based on value of assets. PF, ESI contributions? No, based on salary. The contribution to PF or ESI depends on what? Wages. What about interest on loan? If the loan is borrowed separately for each division based on investment in each division, you can identify. Okay. Return on investment or investment made based on the investment made in each division or department you can identify. Otherwise, don't bring it in P&L account, charge it in general P&L account. If interest on loan is taken for a common purpose, not specifically connected to your operating activity, then take it to what? General P&L account. If it is invested in the business or a departmental store or whatever, departmental undertaking, depending upon the value of investment held, apportion the loan or interest or whatever. Okay. Go to question number 1, which deals majority of the cases in allocation of cost. Capital, which item? Balance sheet item. Sale of computers, it will come in which account? Trading account. Purchase also trading account. Stock also trading account. Then salary already apportioned and given, but it will come in which account? P&L account, directly you can charge. Then advertising, we have to apportion. Discount allowed is given for which one? Computers and what? Printers, this we have to apportion. This we have to apportion. Drawings will be adjusted in balance sheet. Drawings will be adjusted in what? Balance sheet. Building also it will come in what? Balance sheet. Equipment for computers and printers given separately. So depreciation on computers will go to what? Computers. Depreciation on printers will go to printers, like that. Debtors and creditors is which item? Balance sheet item. Bank balance, balance sheet item. Rent will be apportioned based on area occupied. Canteen charges will be based on number of workers. Number of workers. Heating and lighting also can be based on what? Area. Heating, lighting expenses can be based on what? Area. Insurance on stock can be based on what? Stock. General administration expenses, let us see. If no base is available, we will go with what? Sales. Then we are given outstanding salary for computers, printers, heating and lighting is given. General administrative expenses, prepayment 33 and 80 is given. All those things we have to adjust and apportion. Then closing stock value is given to us. Depreciation 10% to be provided on WDV. Managers of computers and printing department are to be paid a commission of how much? 5%. It is not given after charging, etc. Just 5% you have to provide. We are given number of workers, average stock levels and what? Floor area. Then general administrative expenses are primarily incurred in relation to which one? Processing of which one? Purchases and which one? Sales invoices. We can go with sales ratio. We can go with what? Sales ratio. Okay. We can go with sales ratio. Let us do it together. See, there are two methods of preparing. Normal trading P&L account. Opening stock, purchases, sales, closing stock. For a better display, for a better understanding, we go with a statement format. Okay. Sales minus what? Cost of goods sold will give us which one? Gross profit minus all expenses apportioned will give us which one? Net profit. In that style, let us work out. Let us do it together, this particular problem. Start. But of course, in the exam, when they ask you P&L account, you have to start in a normal way only. Opening stock, purchases, direct expenses, credit side sales and which one? Closing stock you can record and find out what? Gross profit. Start. Departmental trading P&L account heading. Departmental trading P&L account. I'm not doing it in T format. I'm doing it in which one? Statement format. Income minus expenses method. The exam, of course, sales, of course, will be credited. Start. Particulars and two columns. Sales is given directly. 59,000 and what? 29,500. Look at administrative expenses. Is it based on purchases or based on sales? Both purchases and sales given. Then we can apportion based on gross profit ratio also. We will see. Sales 59,000 and what? 29,500. Less cost of goods sold. How to work out cost of goods sold? Opening stock plus purchases minus closing stock. Direct expenses, is there any? Any direct expenses given? No. This will give us cost of goods sold. You can do it in a trading account method also. Opening stock plus purchases minus closing stock gives us cost of goods sold. Sales minus cost of goods sold will give us which one? Net profit or gross profit. Gross profit is 39,480, 19,814. Total gross profit is 59,294. Should not have a doubt in this or up to this. Let us apportion the expenses. What are the expenses given? Salaries. Look at salaries. What is the salary given? Computers, how much is given? 20,560. Printers, how much? 15,440. And there is an outstanding salary given. Outstanding salary, add this, how much? 250, and printers how much? 170. So with the salary, you add outstanding salary. Salary plus outstanding salary for computers, salary plus outstanding salary for what? Printer. There is no apportionment here, directly charged. You can take it up. No need to wait. Please take it up along with me. Salary, maybe you can mark it as plus outstanding salary. It's given already allocated and given. Directly we charge it. Then advertising expenses will be based on sales. What is the sales? This ratio. 59,000 is to 29,500 ratio you allocate. 590 is to 295 ratio. You need not work in the calculator, you can trust us because it is done by the computer, it will be correct. In the exam, you can do it in the calculator. Okay, so advertisement expenses apportioned based on what? Sales. 590 is to what? 295. Just take it as it is because when you do it in the calculator, it will take some time. At home, you can verify this later if you have time. Then, what is the next one? Discount also based on what? Discount allowed. What is the discount allowed? If it is given common, you would have gone by sales ratio. Here they have given directly. Discount, is it a common expense given or direct specific expense given? Check this. Specifically they have given for computers and printers. So it's a direct one. 400 and what? 200. Next. Rent and rates minus prepaid expenses will be apportioned based on what? Floor area. What is the floor area given? What is the floor area given? This one. 8,000. Yes, 8,000 and 4,000. 2:1 ratio. 2:1 ratio. Rent and rates minus prepaid expenses. At home, you can cross check all these ratio, allocation, etc. What is the next one? Canteen charges, Irka. Yes, let us go. What is the canteen charges? Let us go in the same order. Canteen charges will be based on what? Number of workers. Number of workers given. What is the number of workers given? 18:12. This ratio. 18:12 ratio. Based on number of workers, you allocate which one? Canteen charges. Next. Heating and lighting based on floor area. Heating and lighting plus outstanding expenses. Heating and lighting plus outstanding expenses given in adjustment number 1. Look at the adjustment number 1. What is the heating and lighting outstanding? Is 20. Add the 20 and apportion based on what? Floor area. What is the floor area? 8,000, 4,000, 2:1 ratio. Next. Insurance on stock. Insurance on stock will be based on average stock held throughout the year. Suppose if average stock is not given, then you can assume either based on opening stock or closing stock method. Since average stock is given, we go by that. What is average stock given? 5,000 and what? 4,400. 940. So 500 and what? 440. 940 is the total expense. 5,000 is to 4,400 ratio. If that average stock is not given, you can apportion based on closing stock also. Then, general expenses. Pay attention. Look at point number 7. General expenses primarily incurred in relation to what? Processing of purchases as well as what? Sales invoices. It is not given purchases or sales. It is not separately given. It is given for together. If it is given on say it's like administration expenses are based on sales. You can apportion based on which ratio? Sales ratio. If it is based on purchases, you can apportion based on purchase ratio. If it is based on both, then you can apportion based on what? Gross profit ratio. You can apportion based on gross profit ratio. Gross profit ratio means this ratio. It is like 39,480 divided by 59,294 into the expense. 19,814 divided by 59,294 into the total expense. So general administrative expenses minus prepaid expenses. General administrative expenses minus prepaid expenses. It will be apportioned in which ratio? Gross profit ratio. Next. What is the next one? Depreciation. Depreciation is given for which one? Equipment, how much per computers? Okay. Equipment, how much percentage? 10%. Equipment, 10%. So, this is direct. Computers, how much is given? 18,000 into 10%, 1,800. Printers, 7,000 into 10%, 700. WDV given. That is directly given to us. 18,000 into what? 10%, 1,800. For printers, 7,000 into 10%, how much? 700. Then commission to the manager we have to work out. Commission to the manager we have to work out. How to work out the commission to the manager? Simple. Gross profit minus all the expenses. Gross profit minus what? All the expenses for computers and printers, you do it. Tell me the profit before commission. Gross profit minus all the expenses. Is it given after charging such commission? Something like that? No, no such words are used. So you can directly apply what? 5%. First work out the commission before all these things. $30,000, 39,480 minus all the expenses. 12,077. What is the manager's commission to be paid? How much percentage to be paid? 5%. Okay. The wording is before charging such commission. Before charging is 5%. On this 5% you can apply. You will get the commission. What is the commission? 604 and what? 41. Include that commission also in the expenses. So profit before commission into 5%, we get this commission. Include that commission also. Now reduce from gross profit. Eliminate all expenses including this commission. Here, profit before commission is gross profit minus all the expenses. That into 5%, we get which one? Commission. Now eliminate commission also. You will get departmental net profit. Since the administrative expenses are based on both purchases and sales, we apportion this based on which one? Gross profit. Do they ask you to prepare only P&L account or balance sheet also? Balance sheet. Start. You can try. Complete this and start with balance sheet. For a better display, just do it in statement style, liabilities, assets, like that, so that the font size will be a little bit bigger. Okay, what is the capital? 71,000. Add, listen, which department profit you will add? Both. Add both the net profits. What is the net profit of both? 12,259. 12,259. Is there any drawings given? Check it. Yes. Yeah. Drawings. Yeah. 3,000 directly given. Adjust it. Minus drawings. Opening capital. Add net profit of both the departments. Minus what? Drawings. Opening capital. Add net profit minus drawings. What are other liabilities? Creditors. Creditors 5319. Then what are the other liabilities? Yes, all the outstanding expenses will come. Outstanding salary, both. For both the divisions, you can just add and put how much? 420. Outstanding salary 420. Then heating and lighting. Heating and lighting outstanding. Yes, how much is outstanding? 20. Then wait. This commission, is it paid or not paid? This commission 604 and 41. Now only we calculated the commission. We have not paid it. So commission, manager's commission, that also should be considered. Manager's commission, add both. Manager's commission outstanding also should be considered. Any other liability? Any other liability? So salary, heating and lighting, salary of both the divisions, add up and put. Manager's commission also, just while working out the P&L account we calculated, otherwise it's not given in the trial balance. It is not paid, it is outstanding. So you get total of liabilities, then you get assets. Start with assets next. Assets ensure that you are eliminating depreciation also. Equipment, you can add it together, eliminate depreciation 10%. Record debtors, closing prepaid items. Building, I hope there is no depreciation. You can record it as it is. Equipment, there is a depreciation. Add both minus depreciation. Equipment 18,000 plus 7,000 minus 10% depreciation. Equipment, computers and printers 18,000 plus 7,000 minus full depreciation for both. Then what is the next one? Debtors minus provision for bad debts, if there is any. Debtors no 10,200. Then bank balance 5,600. Bank balance 5,600. Then prepaid expense. Yeah, stop. We'll come to that. All the prepaid expenses you have to take it. Administrative expenses 33 prepaid. Rent and rates 80 prepaid. You have to take it. Then closing stock also you have to consider. Closing stock also you have to consider. Yes, you will get total of assets. So this problem primarily deals with which one? Apportionment of expenses. Equipment less depreciation. We'll go to question number 3 after learning a small point. Have you taken up this? Okay. Interdepartmental transfers. Interdepartmental transfers. Okay. Where to record the interdepartmental transfers? For example, Department A transfers to Department B. If Department A is transferring to Department B, where will you record it? Simple, in the trading account. In the trading account, what will you do? Credit the giver, debit the receiver. Simple. Start. Interdepartmental transfers. Number 1. It is recorded in trading account. It is recorded in trading account. Credit which department? Transferring department. And debit which department? Receiving department. Interdepartmental transfers are recorded in which account? Trading account. Same like goods sent to branch. We credit the head office and debit what? Branch. Clear? Head office is transferring, credit the giver, debit the receiver, goods are received by branch. Or you can look at like this also. Credit the transferring department. For the transferring department, it is like a sales. For the receiving department, it is like a purchases. That way also you can take it. Now listen. If the departmental transfers are cost price, no problem. X is transferring to Y at cost price, no issues. But if the departmental transfers are taking place at selling price only, there is a trouble. Start. If interdepartmental transfers takes place at selling price. If transfers are at which price? Selling price. If transfers are at selling price, then what we have to do is we have to remove the loading. We have to remove which one? Loading. Where to remove the loading? Start. A general P&L account is prepared. A general P&L account is prepared to remove the stock reserve. A general P&L account is prepared to remove the stock reserve. Pay attention, I will tell you. For how to remove the stock reserve, we will bring the net profit of department, let us assume there are department X and department Y in a common column. Let us bring it. The department net profit will be brought into a common column. That is which account? General P&L account. Then some expenses may not be connected to your departmental activity. Okay. Some abnormal losses or some the company has committed some mistake, because of that huge loss on sale of investment was there. So that will be charged in which account? General P&L account. Expenses not related to any department. It's not common expenses. That is not connected to my departmental business at all. That will be charged in which account? General P&L account. Wait. Here also, opening stock appears in which side? Debit side of trading account. How to remove the stock reserve? By stock reserve. By stock reserve. Will you remove on the entire stock? No. You see the transferred goods? Transferred goods? No. Transferred stock. That's better. Whatever is the transferred stock which is lying into which department's GP ratio? For example, I am department X, you are department Y. You transferred stock to me, I am keeping the stock. Stock is with X. Stock is with X. So take that stock into who is charging the profit? Y is charging the profit into transferring departments which ratio? GP ratio. Okay. So transferred stock into transferring departments GP ratio. Of course, you will take last year GP ratio. Why? This is on which stock? On opening stock. Stock reserve on the opening stock. So take the opening transferred stock into which one? Transferring department GP ratio which year? last year. Same way for the closing stock, you will put what? To stock reserve, simple transferred stock, whatever is unsold, into which one? Transferring departments, which ratio? GP ratio. You will take which year? Current year GP ratio, because closing stock will be out of current year transfer, take current year GP ratio. Okay. So for opening stock, you take which ratio? Last year GP ratio. Now, how to work out GP ratio? How to work out GP ratio? Simple. What is the formula? Gross profit divided by sales into 100. Very good. Think. Gross profit divided by sales plus transfer into 100. Why? Why? For example, you are department Y, you are transferring goods to me at normal selling price. Now you are making the gross profit out of what? External customers also you are selling with a profit. To me also you are transferring at what? Profit. So while working out gross profit ratio, what you should do? Your gross profit divided by sales plus what is the transfer made into 100. That will give us which ratio? Gross profit ratio. So for the closing stock, take which ratio? Current year GP ratio. For opening stock, you take which ratio? Last year GP ratio, not the entire stock, only which stock? Transferred stock you should see. So the balancing for will be final net profit. So take up this. This is a point of learning in departmental accounts. For opening stock, we remove the reserve in the credit side. For closing stock, we remove the loading on the debit side. How to remove the stock? Reserve, simple. Take the transferred stock into transferring department's GP ratio. Transferred stock into transferring department GP ratio of which year? Of current year for closing, for opening, last year's GP ratio. Take up this. How to work out gross profit ratio? Gross profit divided by sales plus transfer into 100. Pause. Take up this, we will proceed to the next question next. After taking up, read the next question. This is the most important point of learning in departmental accounts. One is how to allocate common expenses. Second is which one? How to remove the stock reserve. It is simple. Your stock into my ratio. If I transfer the stock to you, stock is held by you. So you take your stock into the transferring department's GP ratio. So while working out GP ratio, since the goods are transferred at selling price, the gross profit is earned both on sales as well as what? Transfer. Please go through question number 2. A Limited is having two departments P and Q. Department P is selling the goods at what? At normal selling price. From the following, prepare departmental trading P&L account and also ascertain what? Net profit to be included in the balance sheet. That is after elimination of stock reserve. Opening stock is given for P and Q. Purchases are given for both. Goods from department P, which means who is the transferor? P is the transferor, Q is the receiver. We are given wages, traveling expenses, closing stock at cost to the department is given. Sales, printing and stationery is given. The following expenses are incurred for both departments put together. Salary, advertisement expenses, general expenses, depreciation to be charged at the rate of what? 30% on plant and machinery value. Last one. Advertisement expenses to be apportioned based on turnover, okay. Salary in the ratio 2:1, depreciation in the ratio 1:3. General expenses are to be allocated in the basis of what? 3:1. So they have given the basis of allocation directly. According to that, we are going to allocate. So we can start with which account? trading account, either in a statement style or in a normal method. You can try. Start. Let me to work out in the statement style itself. What is the sales? 30 lakhs and what? 20 lakhs. Transfer to the other department also takes place at what price? Normal selling price. So total revenue is like 38 lakhs and 20 lakhs. This is external sales, this is internal transfer, that's all. On both, the department P is earning what? Profit. Then cost of goods sold will be opening stock plus purchases plus transferred goods, direct expenses minus closing stock. Otherwise, all these things you will debit in the P&L account. Then you get cost of goods sold. Total sales minus cost of goods sold will give us gross profit. Otherwise, we have prepared by trading account method. Are you getting this 9,50,000 and 9,09,000? Wait, which department is transferring the stock? Department P is transferring the stock. Sales will come on the credit side. Transfer will be recorded in which column? You need to prepare in T format. By transfer, in which column you will record? P's column you will record. Closing stock will come in the credit side. Closing stock will come in the credit side. Then opening stock, purchases, transfer in P's column, wages, all these things would have been debited. When you prepare by ledger method, what is the gross profit? 9,50,000 and 9,09,000. Nearby, you can work out the GP ratio. What is the GP ratio? How to work out GP ratio? Yes, gross profit is 9,50,000 divided by sales plus transfer into 100. Gross profit divided by sales plus transfer. This will be useful for us in the future for calculating which one? Stock reserve. Gross profit divided by sales plus transfer into 100. How much percentage you get? 25%. Sale plus both you have to take. 9,50,000 divided by 38 lakhs into 100. Then charge all the expenses. I hope the basis is given for you already. Sales and transfers on the credit side. Opening stock, purchases, this transfer for Q, wages on the debit side. Closing stock on the credit side would have given you a net gross profit of how much? 9,05,000 and 9,09,000. How to work out GP ratio? Gross profit divided by sales plus transfer into 100. It will give you 25%. 25%. Then charge all the other expenses. What are the expenses given? Look at the adjustment. What are the expenses given? Traveling expenses, direct. Salary, advertisement, general expenses, depreciation. You charge and allocate as per the instruction given. Charge all the other expenses. Traveling expenses, printing and stationery given directly. Then salaries in 2:1 ratio. Advertisement expenses in the ratio of sales. General expenses in 3:1 ratio. Depreciation they have given 1:3 ratio. Work out the total depreciation 1:3 ratio. What is the total net profit? 6 lakhs 54,200. Add both the net profits, you get 6 lakhs 54,200. Do they tell you about what is the closing stock, transferred stock held? Do they tell you about what is the transferred stock held? No. Any doubt so far? Any doubt in the GP ratio? Nine lakh 50,000 divided by sales plus transfer. You get 25%. Up to this, suppose if the question is for 10 marks, up to this if your solution is correct, it will be only 3 to 4 marks. The next only is going to be the troublesome area for us. Who transferred to whom? P transferred to Q. Everybody paying attention. Everybody paying attention. Who transferred to whom? P transferred to Q. Who charged the profit? P. Stock will be with whom? How much of stock is with Q? That is transfer. 8 lakhs is transfer. 8 lakhs is transfer. My question is, how much of closing stock will be with Q? That anybody can tell. How much of transferred goods are there with Q? Pay attention. Who transferred stock? P. To whom? Q. Okay, how much? 8 lakhs. Do you keep everything in the closing stock? No. Now, look at Q's closing stock. What is the Q's closing stock given in the problem? 2,09,000. 2,09,000 is the Q's closing stock. My question is it entirely from the other department? Is it entirely from the other department? Look at, they also have their own purchases. Department Q have their own purchases. We have to remove profit for total stock or only for the transferred goods lying with Department Q. We have to eliminate profit only for the goods which are transferred, lying unsold or unused with which one? Other department. So, can we put 2,09,000 into 25%? What is the total stock with you? Q. 2,09,000. Can I put into 25%? No. This entire stock is not transferred from me. Because you made your own independent purchases for how much? 3 lakhs. You have your own independent purchases. Whatever is the goods transferred from me will have which one? Whatever is the goods which is transferred from me will have which one? The profit. Think and try. 25% is okay. But what stock value into 25%? 1 lakh? Not 1 lakh 52. Think. Now, do you understand what is the stock with receiving department? 2 lakh? What is the stock with the receiving department? 2 lakh? 9,000. This 2,09,000 into 25% you should not put. Why? This 2,09,000 is the total stock held by the receiving department. In this, you have to identify what is the transferred goods. That is not 8 lakhs. That is the total transfer made. Think. Let me do work along with you. Pay attention. Is there any debit side items? Let us see. For department, which department? Department Q. Who's having the stock? P transfer. So department Q. Is there any opening stock? No opening stock. Then they made purchases. 3 lakhs. 3 lakhs. Plus they also got transferred goods. What is the transferred goods? 8 lakhs. Plus any direct expenses? Wages. What is the direct expenses? Wages? 2 lakhs. Huh? Wages? 2 lakhs. What is the total? Total debit. What is the total debit? Opening stock is not there, plus purchases this much, plus transferred goods this much, plus wages this much. Total debit in the trading account is how much? 13 lakhs. Pay attention. Most crucial point, listen. This includes transferred goods worth how much? 8 lakhs. This includes transferred goods worth how much? 8 lakhs. Therefore, what is the closing stock total? Total how much? 2 lakh? 2 lakh 9,000 includes how much of transferred goods? Do you understand? In the debit side, you find the opening stock, purchases, transferred goods, wages. What is the total? What is the total? 13 lakhs. This includes, total debit includes what? My total of direct expenses is 13 lakhs. This includes transferred goods worth how much? 8 lakhs means, so closing stock is valued at landed cost. So 2 lakh 9,000. This includes how much of transferred goods? Cross multiply. 2 lakh 9,000. This into 8 lakhs by 13 lakhs. Do you understand? I repeat. These are the debits done during the year. What is my total debit? 13 lakhs. This 13 lakhs include 8 lakh worth of goods. So when we take the same proportion, the total closing stock 2 lakh 9,000 includes how much of transferred goods. So 2 lakh 9,000 into 8 by 13. When you apply, how much you get? This much transferred goods. Therefore, stock reserve is equal to on this how much percentage? 25%. 25%. So simple. When you prepare, pay attention. When you prepare general P&L account, we will bring the net profit of both the departments. By net profit of which department? Both the department. Tell me the net profit of both the department together. 6 lakhs? 45,200. Buy stock reserve will not be there, because there is no opening stock with other department. Okay. To stock reserve, how much? This amount. This will give us the final net profit. Final net profit is, okay, 6 lakhs 45,200 minus this one. Once again, I repeat, pay attention. Let's assume we are all belonging to which department? Q department. We had purchased this much, we have got transferred goods this much, plus direct expenses this much. What is my total value? This 13 lakhs includes how much of transferred goods? 8 lakhs. Closing stock is out of this total only. What is the total closing stock? 2 lakh 9,000. This will include how much of transferred goods? So what is the proportion of transferred goods? 12 lakh 8, that is 1,28,615.4. So stock reserve is this into 25%. Take up this. Another fantastic thinking level problem for examination point of view. Because if you have not solved this in the classroom, at the exam, first you will not think about stock reserve. Number two, you will directly take 2,09,000 into 25%. But the 2,09,000 is entire. Is it the total stock transferred, or is it include? Is it like transferred goods? No. We have purchased goods. Pay attention. Purchased goods will be at what price? Cost price. Wages also actual cost only we will record. Only what will be having this one? Transferred goods. Otherwise, you can check directly here also. What is the proportion of transferred goods to total debit? What is the proportion of transferred goods to total debit? 8 by 13. Yes. 2,09,000 into 8 by 13. 2,09,000 into 8 by 13. That is your stock reserve. That into 25% is your stock reserve. Take up this, then we will proceed further. Do you understand GP ratio of 25%? Gross profit divided by sales plus transfer into 100. Do you understand the concept of stock reserve? Stock reserve should be eliminated only on which goods? Transferred goods lying unsold. Lying unsold. In this problem, if you look at total transfer, it is 8 lakhs. Don't remove loading on full 8 lakhs. Remove loading only on what? Transferred goods included in the closing stock. Stock reserve is this one into 25%. Shall we? Okay, probably this problems you would have done in the regular class itself. That interdepartmental transfers, okay, with rectification of errors. So definitely in any class you could have done this particular problem, but still that is a point of testing in the exam also. Okay, we'll see that next. Have we taken up? Shall we? Have we taken up this one over? Shall we continue? Look at this. This is one of the most repeated examination question. Department X is selling the goods to Department Y at a profit of 25% on cost. X to Y, 25% profit on cost. X to Z, how much profit on cost? 10% profit on cost. Y to X and X to Z, how much is given? 15% and 10% on sales is given. If you look at first two are on cost. Next two, what is given? Next two on sales given. Again next two. Again next two 20% and 25% on cost is given to us. Read further. Next one is the most important highlighting point for us. Departmental managers are entitled for a commission of how much? 10% of net profit subject to unrealized profit on the departmental sales eliminated. Look at the next one. Departmental profits are given. What is departmental profits given? After charging managers commission, but before the unrealized profit. What is the error they made? What is the error they made? They have not eliminated stock reserve, but they charged what? Managers commission. Actually, they should have done like this. Profit, net profit less stock reserve they should have done. Then net profit before commission they would have arrived at. On this they should have worked out what? Commission and arrived at what? Final net profit. This is a correct method of doing. Okay. Profit arrived at as per departmental accounts. Eliminate what? Stock reserve. You get net profit before commission. Eliminate commission and you get which one? Final net profit. But what they have done is net profit they have taken. They have eliminated what? Commission and arrived at what? Final net profit. So what would have been wrong? The final net profit is wrong. Commission is also wrong. Why? They should have eliminated stock reserve and calculated what? Commission. Without eliminating stock reserve, they have calculated what? Commission. Okay, that's what is given. Departmental profits after charging which one? Managers commission, but before adjusting which one? Unrealized profits are given. Then XYZ profit is given. That is the wrong profit given. Stock lying at the different department means closing stock lying with different departments. X to Y transferred, X to Z transferred. Y to X transferred, Y to Z transferred, Z to X transferred, Z to Y transferred, like that. They ask you to rectify. They ask you to which one? Rectify. So what to do? How to rectify this? What is the mistake they have done? Net profit, they directly reduced what? Commission and got the final net profit. Let us do rectification. Let us take the net profit, add back the wrong commission calculated. Then we will get what? Net profit as per departmental P&L account. Then less which one? Stock reserve. Then let us work out what? Correct commission. Okay. So add back wrong commission. You will get the profit before commission. Eliminate stock reserve and recompute what? Correct commission. You will get the answer. Let us do it together. Pay attention. Start. Okay. Let us start together. What are the departments? X, Y, Z. Let us start. This problem, if you have done in the class, no problem. Take it like a quick revision kind of a thing. What is the final net profit given? What is the final net profit given? 36,000. Then final net profit given 36,000, 27,000, then 18,000. Wait. This is after commission. This is after which one? Commission. $36,000, right? Pay attention. We have to add back wrong commission. You have to add back wrong commission. How to add back? Will you take this into 10%? No, listen. If net profit was 100, if net profit was how much? 100, they worked out commission, how much? 10. This is given. How much is given? 90 is given. Okay. If net profit was 100, they eliminated commission 10 and they've given 90. If 90 is this much, what is 10? So you have to multiply 10 by 90. 10 by 90. Why? Because this is after calculating commission they have given. So 10 by 90. So multiply this 36,000 into what? 10 by 90. How much? I got 36,000 into 10 by 90. Why? Okay. Let me do it in the next row. Sometimes it works. 36,000 into 10 by 90. Why it is so, I do not know. We'll leave it. Okay. This is 27,000 into 10 by 90. Probably that recognize that row as date. This into 10 by 90. So add back wrong commission. You will get what? Net profit before commission. Please work out along with me. Don't wait. 36,000 plus how much? 4,000. This will give me net profit before commission. You can cross check also. This was a commission this was a profit they worked out. On that they applied what? 10%. 40, 30, 20. On that they applied 10% and they've given this. So net profit before commission we arrived at. What is the next one you have to do? Pay attention. This is also most important. Because normally, from the wrong department, you should not eliminate stock reserve. Less stock reserve. Pay attention. From X to Y it is transferred. To Z also it is transferred. What is X to Y transferred stock? X to Y transferred stock? 15,000. X to Z transferred stock? 11,000. What is the profit margin? 25% on cost and what? 10% on cost, like that it is given. X to Y, what is the stock transferred? 15,000 into 25 by 125. 1/4 on cost, 1/5 on sales. That way also you can work out. Once again, who's holding the stock? Y is holding the stock. How much? 15,000 into 25 by 125. How much you get? 15,000 into 1/4 on cost, 1/5 on sales. That is what? 25 by 125. How much you get? 15,000 into 25 by 125. How much you get? 3,000. Everybody paying attention. What is the profit on cost? 25%. On sales it will become 25% on cost. 25 by 100 on cost. On sales it will become 25 by 125. 1/4 on cost, 1/5 on sales. Same principle. So 15,000 into 25 by 125. How much you get? 3,000. No. Listen. From which department you will eliminate 3,000? X or Y? Who's keeping the stock? So what you would have done is, okay, minus 3,000. No. Who charged the profit? Stock is with department Y. Who charged the profit? X charged the profit minus 3,000. Then X to Z also. What is Z stock? 11,000 into 10 by 110. How much? 1,000. Simple. Whoever is charging profit, profit is included in my department. If I am X, I am transferring to Y and Z. Okay. So stock is with you, but who charged the profit? X charged the profit. Eliminate from X. Okay. So normally in a example, the 3,000 will be in a Y column and 1,000 in what? Z column, like that we will put. So who transferred the stock? That department you have to consider. Then from Y to X. From Y to X, what is the stock? 14,000. 14,000 into how much percentage? Here, look at. Direct straight away it is given 10%. Sorry. This one. 15% and what? 20% on sales. This into 15%. 14,000 into 15%. Because Y transferred Y's column. Then to Z, how much of stock is kept? This 12,000 into how much percentage? 20%. 12,000 into 20%. How much? 2,400. Then from Z to X. How much? 6,000 into what is the profit margin given? 20% and 25% on cost. So into 20 by 120. How much? 1,000 to Y. 5,000 into 25 by 125. How much it is? 1,000. Adjust this. You will get corrected net profit before commission. Otherwise, you can call it as this is a profit after eliminating stock reserve. This is what is the mistake they have done. We have corrected it. Now, less correct commission. How much percentage? 10% of net profit. So, this into 10%. Not 10 by 90 or 10 by 110. So, final net profit after rectification. What is the final net profit after rectification? take up this. Do you understand? The department which is transferring, in that department the profit should be eliminated. Already the receiving department has purchased at which price? Invoice price. So anga poi eliminate pannidadinga. Already they have included the profit in stock. Okay, who charges profit? From that department you have to eliminate. Then final net profit, add back wrong commission, you get net profit before commission. Eliminate stock reserve, then you get corrected net profit before commission. Eliminate commission, 10% on net profits, you get final net profit after rectification of errors. This is net profit before commission and stock reserve. This model question is repeatedly tested in the exam, one of the repeated model in the exam. This can be tested for maximum 5 marks. Maximum 5 marks. Because what is there in it? We add back wrong commission, we eliminate what? Stock reserve, then work out what? Correct. It should not take, if you practice this in the class, it will take only 4 or 5 minutes of time in the exam. Simple rule of allocation. Okay, for every 1 mark, you can expect, you can spend about 1.8 minutes of time. Keep that rule. Sometimes you may take more time, 2 minutes, 3 minutes also, but 10 minutes for every 1 mark. 10 marks question I spend for 1 hour, then the time will run very heavily. So average time allocation, the thumb rule is for all the papers 1.8 minutes for what? 1 mark. Suppose if you are able to save time on some questions, then you can extend the time on tough questions kind of a thing. Shall we? Question number 4, we will come to it. Question number 4, we will come to that later. We'll do question number 5, then we'll come to question number 4. Read question number 5. This is also a fantastic question that can be tested in exam. It should not take more than 10 minutes for us to work out. Let us see. The following information is provided to you by Shobha Departmental Store for the ending 31st March 2018. Look at the purchased units. What is the purchased units? Is it value or units? Units, 2,500, 5,000 and what? 6,000. These are all purchased units. Then sales units and selling price is given to us. Closing stock unit is given to us. The total value of purchases how much? Total value of purchases is 15 lakhs. They have not given individual units, cost, all those things. Then it is observed that the rate of gross profit is same in which department? Each department. This model problem you have done it in the class, or the same problem you could have done it in the regular class? Okay, no issues. I will solve it. It will take just lesser time. Now the hint for solving the problem is they are earning what? Uniform rate of gross profit. What is the total cost of purchases? So immediately in the exam, if you have not tried this at home, at home or in class, you will do 15 lakhs divided by 2,500 plus 5,000, 6,000. Total cost divided by total quantity, you will work out which one? Cost per unit. That will result in same cost per unit for everything. But whether gross profit ratio is different or same? Okay, do it in calculator. 15 lakhs divided by total quantity. Divide and see. 15 lakhs divided by total quantity. 15 lakhs divided by, I hope 13,500. How much you get? Purchase units. 15 lakhs divided by 13,500. How much you get? 111.11. But if you look at selling prices, 160 for this, 180 for this, and what? 200 for this, and they are telling you uniform rate of gross profit in all the departments. So you cannot divide like that. So first we have to find out profit margin. Wait. For finding out profit margin, 2 values we need. What are the 2 values we need? Sale value and which one? cost. Sale value and which one we need? Cost. Start. Please do it along with me. To compute gross profit margin, sale value is required and cost is required. So we cannot work out cost of what is available. Purchase is available. So let us work out sale value of purchased goods. Sale value of purchased goods. What are the departments? X, Y. This is not sales. This is a sale value of purchased goods to find out the gross profit margin. How many units purchased? How many units? 2,500 units. If it is sold for how much? 160. What is the sales? Okay. Same way for Y. How many units? 5,000 units into 180. Tell me fast. We'll finish up. Please do it along with me. Into 180. Department Y. Department Y. Don't take sales. We are working out what? Sale value of purchased goods. Then for Z, 6,000 into what? 200. 12 lakhs. So what is the total sales? You can do it along with me. Don't wait. What is the total? 25 lakhs is the sale value of which goods? Purchased units or purchased goods. What is the cost of purchases given to us? 15 lakhs. Cost of purchases given to us is how much? 15 lakhs. So we get profit margin. What is the profit margin? 10 lakhs. Profit margin is 10 lakhs. So if you work out percentage, simple, 10 lakhs out of what? 10 lakhs out of 25 lakhs into 100. How much percentage? 40%. So this is relevant for solving it. Take up this and let us proceed. Clear? If all the goods are sold, we will get 25 lakhs. Okay. We purchase this for how much? 15 lakhs. Profit margin is 10 lakhs, which means we have how much percentage? 40%. Selling price minus profit, that is 40%, will give us cost that we multiply with purchased units. So we'll get purchase value. X, Y, Z. What is the selling price? 160, 180, 200. Profit 40%. So this will give us cost. Selling price minus profit will give us what? Cost per unit. This you multiply with purchased units. How many units you purchased? 2,500, 5,000 and what? 6,000. This is the purchased units. Multiply that, you will get the purchase value. You can cross verify your answer also. Or this is what required for your trading account. Yes, we get how much? 15 lakhs. Okay, selling price minus profit 50% will give us which one? Cost of the goods. Okay, that multiplied with purchased units. Cost multiplied with purchased units, which gives us which value? Purchases value. So cost per unit is 98, 96, 108 and what? 120. 96, 108 and what? 120. It is not same. This is a verification for us, and this is what is required for which account? Trading account also. Closing stock units given. Multiply units into cost, you will get the value. We assume that in the absence of information, we assume that there is no inflation or change in the value of material. XYZ. Cost is how much? 96, 108, 120. How many units given in the problem? How many units? 250 units, 400, 140. Multiply this, you will get the value. This we require for which one? Trading account. Sales values are available, I hope. Sales units, this into selling price. Opening stock we'll find out. What is the sales units given? 2,550, yeah? 2,550, 4,800, 6,240. This into selling price will give us sale value. This is the sales to be recorded in trading account. Now, what is missing? Opening stock as well as value, both are missing. Pay attention. We sold out some units, okay. We sold out some units. And we are given closing stock also, and we purchased some units. Balance will be which one? Opening stock will be there. So XYZ. How many units sold out? This one. And this much of closing stock is kept with us. Minus, we purchased how much? How much we purchased? How many units for X? 2,500 we purchased. 5,000 we purchased out of this. 6,000 we purchased out of this. So balancing for would have been taken from which stock? Opening stock. This much is sold, this much we had closing stock, this much we have purchased, means balance would have been out of which one? Opening stock. This you can multiply with cost and you will get the value. Now you can prepare the trading account after this. So the hint for us is uniform gross profit ratio. So using that we found out this percentage, 40%. So from selling price, eliminate profit margin, you get what? Cost. Cost into purchase units will give us what? Purchase value. We verified that 15 lakhs first. Closing stock into cost will give us the value. Sales into selling price gives us sales. Then we sold out this much, closing stock is this much. We purchased, the balancing for is which one? Opening stock we find out. Cost, we assume that the same cost is there for last year also. We get the value of opening stock. Now you prepare trading account with 3 columns on each side. What are the departments? X, to opening stock. We found out the value of opening stock. This one, 28,800, 21,600, and which one? 45,600. Purchases also, we worked out the value. Separately, we have done a working note. This one, 2,40,000 for Y, 5,40,000 for Z. This one, 7,20,000. By sales, sales value we worked out. Sales into units we worked out. By closing stock, what is the closing stock value? 24,000, 43,200 and what? 16,800. As a balancing figure, you get to gross profit. Or you can do sales into 40% should go the gross profit. Verification is 40% of sales should be your gross profit. This gross profit will be 40% of sales. Over.